Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible.
Welcome back, everybody, to another Roundup edition of On the Margin. This week, we just got the triumvirate again, as Mike Ippolito is out and about doing important founder things. We don't know what, but we got the trio here this week. What's going on, guys?
Crazy week. It should be a fun one.
I'm glad Mike's not here. He's kind of boring.
At least we got Quinn here for some hot takes that I know he's ready to just fire away.
Oh, yeah. How many coffees you on?
Actually, just one today, about 3/4 of the way through. It's not a cold brew, though, so it's a little tamer, I think.
Wimpy Floridian coffee?
No, the Cuban stuff, man. If you get the right Cuban stuff.
You guys ever have Vietnamese coffee? That stuff hits like a brick.
Oh, yeah.
Dude, the other one is Greek. I don't know, like the Greek and Turkish stuff is like
straight caffeine injection.
Well, guys, I want to start with talking about the FOMC. We had the meeting on Wednesday, which was a few days ago. Pretty interesting what occurred. Everybody was expecting, obviously we got the dot plot update that happens every 3 months, so roughly around 4 times a year. So we got that new updated dot plot, and with it a few updated projections on things like where they forecast the unemployment rate, where they forecast the longer run neutral rate, which was really interesting. But overall, most people expected to have only 2 cuts, updated from their previous dot plot of forecasting for 3 cuts for 2024. But they actually came out and with only 1 cut forecasted when you look at the median aggregation of it. And that caught a lot of people by surprise. It caught me by surprise. Literally like 2 minutes before that, I was talking to Jack Farley and we were both saying, okay, I think it's going to be 2. And then literally 30 seconds later, we just got completely, taken out to the woodshed because came out swinging with 1 cut. So that was really surprising to me. And that, I think most of the market took that as hawkish. But what was really interesting is that the market didn't really react too strongly to it, at least right away. The preface for that obviously is that morning we had the CPI print that came in. It came in soft on basically every metric. So that got people really excited for more rate cuts to come. And then this came out. And then the distinction and the discussion came around in the press conference was just trying to understand, okay, when were these dot plots basically agreed upon? Was it before the CPI print came out or was it after? Did they have an opportunity to actually revise their dot plot projections? And Powell sort of softly talked about it. He mentioned that FOMC members have an opportunity to revise it, but that most don't, and basically left it at that. So the market was left trying to figure all that out. For me, personally, my opinion is that they're buying optionality and they're using the dot plot, which is just basically always wrong, but is useful as a tool for the median term for trying to at least rein in animal spirits in the market. So they know that they can buy optionality with it without doing a whole lot. They got burned in Q1 this year where they started to talk about more rate cuts coming in. And then we got some higher than expected inflation prints that made them look a little flustered. So me personally, it feels like they're buying optionality, but the stage is set for rate cuts. It's just a matter of when. What do you guys, what's your guys' biggest takeaways from the FOMC?
I pretty strongly disagree. So going into this meeting, I think the signs and clues were there. I mean, all the Fed speak from the governors, which to be completely fair is they pivot what they say on it like every 3 days. And it's like a competition who can be most relevant. And in reality, none of them are relevant because you can't believe anything they say. But their tone got pretty the hawkish we've seen in a while. The intermeeting interviews and speak was, it felt a little spooked. So I think, myself included, when that CPI print came was like, all right, they've been dovish. Everybody thought they were going to be hawkish going to every Fed meeting this year. They got the CPI print they needed and they came out swinging. And I actually think the market's still digesting this news because you have the bond market saying, people are pointing to disinflation or deflation or whatever in the treasury market. But to me, it's less that and more, all right, they're actually serious about inflation and monetary policy for the first time in over a year. We saw the opposite in December 23, and I think this is more akin to August 2022, in Montana or whatever, Jackson Hole surprise when Powell said, there's going to be pain. So to me, everything here is hawkish about the dots, about the projections. They raise economic growth, they raise inflation, didn't touch unemployment. And then he came out, and for the first meeting in multiple meetings, even dating back to March, May, and even before that, he talked about labor market weakness as the reason to cut. And then that just disappeared. He gave no credence to it at all. And, then just this morning, you have Mester coming out. They saw the market's reaction, and there's another data point. Oh, we need multiple more months of good inflation data. So to me, the market's still holding on to this hope that they were hedging or they were setting the stage. I just don't see it. And I see a hawkish outcome here, which people are confused because, large cap equities, just NVIDIA and, anybody that says AI in their earnings call, screaming to all-time highs on a daily basis. But if you look across the board, the Dow, Russell, small caps, these businesses are hurting, and unemployment is weakening strongly in the small business sector. But what the Fed is saying is inflation is still too big of a problem. And this is equivalent to Powell saying there needs to be some more pain to get inflation down before we cut, which I'll take them at their word and let's see. But I think there's this liquidity pocket from, earlier end of Q1 that's going to extend due to this lack of liquidity in the near term.
Tyler, where's your head at before Quinn and I get the boxing gloves out?
Yeah. I mean, these meetings are flashes in the pan. How many Fed meetings in the past have you actually remembered 25 bips or 50 bips? I don't think it really matters. I think prices and markets matter more on what they're doing. And I could go through, after you reply to Quinn, I'll run through kind of what I'm seeing in terms of what the market is saying now. But in terms of the dot plots and everything, the bond market's kind of been nationalized in a lot of senses, and 25 bips, who cares? But there are some indicators that are switching here, which I think is important to talk about, but I'll let you rip on Quinn right now.
Based on that meeting and how it went, I have been thinking a lot about CPI and inflation and where it's headed. And the big question for me is, where do rents go? And can we get to their target close enough where they feel comfortable enough, especially paired with how the unemployment rate is going, that they feel comfortable to cut? I pretty strongly believe that they will cut before they get to that 2% target. And when you dig into the weeds and the composition of CPI and what is driving it, this chart is really great from Bank Week. That just shows the biggest delta drivers of inflation from last month to this month. And what you can see is that one of the big ones, the most deflation came from used cars and trucks. For the first time in a long time, the motor vehicle insurance, which has just been running absolutely ripping and has been one of the leading factors for having such upside surprises in inflation, that finally has started to trend lower. And that's basically a lagged indicator of the used car vehicles that I just previously showed as being one of the most consistent drivers of deflation. So when I look at these specifics of what has been driving inflation higher, other than shelter and owner's equivalent rent and that sort of thing, to me, it just feels like a lot of things are rolling over. Obviously, the other side of that discussion is owner's equivalent rent and shelter. This has been the big one. It's basically the reason why we're not getting to this 2% target anytime soon. Owner's equivalent rent and shelter is basically about 45% of the CPI weighting. So it's extremely important what is occurring here. And by all accounts, a lot of people were hoping that the lag nature of this indicator or of this composition of CPI would come back down over time, but it's just not really happening. If anything, as we're starting to price in these rate cuts, we're starting to see housing begin to accelerate again, and that would lead to basically no real further downside in owner's equivalent rent. So for me, the calculus is, okay, it doesn't look like we're going to get to that 2% target anytime soon. But overall, if you look at everything else, we're really close to that 2% target. So is the Fed really going to basically risk the economy because of, I know it's only shelter and people friggin' live in their houses and they need to afford to live and have, like a roof over their heads, but are they really going to sacrifice the potential? When we look at unemployment rates, it's a very reflexive indicator. It's why the Fed is often so late and makes these mistakes at these turns, is because it almost follows like an exponential growth rate, where in the beginning it just trickles up a little bit. Okay, we're at like 4% now, but then it could just reflexively just get carried away. And that makes it so that the Fed needs to react as quickly as possible, even though they often don't. So to me, this is just more so looking like the classic Fed move where, they got ahead of their skis last fall and they pivoted too early, got burnt. They even got burnt, at the beginning of this rate hiking cycle where they were saying that, inflation is transitory, and then they had to catch up hike, panic hike. To me, it just feels like they're just potentially setting up for that same instance, is that if you have this reflexive nature in the unemployment rate, you have basically the rest of CPI rolling lower. Are we really going to sacrifice the entire economy because shelter isn't going back down to 2%? That just feels like a crazy calculus to me. But I also know that is something that I'm concerned about, that my simple framework that I'm thinking about right now is that, like, if the Fed doesn't start cutting by September, we risk that policy mistake. We risk a hard landing. I've been pretty far away from the hard landing scenario for a while now. I still think fiscal provides a floor to like an outright recession. But I think things are getting, a bit more worrisome at this stage. If this is when they're starting to finally start to be serious about inflation, it just feels like the classic policy mistake starting to happen.
I agree with large parts of what you said. One, why pick now? Like, you had 2 years to be hawkish on inflation. You choose now. I mean, you can critique how they went about tightening. They did it via the rate versus the balance sheet, which was the horrible mistake. I mean, and I also agree that actually they probably will cut rates. I don't, this isn't like they're never going to cut rates call, but it's a call that they have kind of iterated that they are okay taking some weakness. Like, for example, housing and rents is the problem. What is a 40 basis point drop in 10-year yields and mortgage rates over the last 15 days going to do to housing? It's going to loosen up, and we know there's huge demand. Look at what home builders stocks have done. They bounced up and took this as very good news. So I just don't see that metric coming down. And I do agree inflation is coming down from where it was, but it's embedded. And to your point, we're not getting to 2. We're not. Actually, this was the first meeting I've seen Powell say something. He said, quote, something like 2.6 to 2.7% PCE is good. He said, like, those are good numbers, which combined with him also saying PCE is lower than CPI by, like, say 0.5%. He's saying that consistently running over 3% CPI is good. Where no one's talking about this. They admitted, like, in the same way that ECB cut rates and said inflation is, expectations are higher. So no one's talking about this. And I think the bond market is just responding to, like, okay, they're actually taking inflation a little more serious. And then on top of that, you say, okay, if he wants to be dovish, he got the perfect market response. The 10-year, which dictates markets, fell, 40 bips in June, loosened things way up under the, mortgages, et cetera. And the S&P ripped to all-time highs. So the markets that are hurt are the same ones he hurt from the get-go: regional banks, crypto, liquidity, small caps, and they don't care. And so I just don't see, I think there's going to need to be more pain. And I actually do expect them by the July meeting to have flipped their tone, but I just think they're going to need a market reaction to justify it and provide that overhead. For the forward guidance is what screws them. Like, it's so useless because they were late. They were late and wrong.
I'm on the opposite side of this, by the way.
They were late and wrong all along the way, and they pivot at capitulation points. It's just like stock and crypto investors who sell bottoms and buy tops. They capitulate right as, and so the forward guidance locks them in. That's my whole point, is that for them to pivot off such stern forward guidance in this meeting within one meeting would be a ridiculous move even by Fed standards. And so to me, the only cover that gives them the ability to do that is weakness or cracks in financial markets.
Yeah. Tyler, why are you on the other side?
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain, which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The Subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on evergreen subnets include Onyx by JP Morgan's. They leveraged an evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible.
All right, you got to go to, what if the market's already saying we're at a 2% inflation target? So go to slide 13. This is the thing where everyone is looking at inflation lagging, but this is 2-year inflation, break evens, which is what the market is pricing 2 years from now to inflation to be. It's at 1.97. Like that's exactly where, the Fed wants to be.
But this has been wrong the whole way up. I mean, this in 2021, this metric was probably at 1 or 2% as well, and it was like completely wrong. So I just don't trust this market.
2021 break evens were at 2.5%, 3%, 4%. So I don't know. It was discounting like massive inflation, but it priced in a little bit. So. But like, check out the next chart is the ratio between forward break evens 2 years. So like what inflation is 2 years out versus what you can buy the 2-year yield nominal bond at. So that is the white line is where the nominal bond is trading. And the orange line is where break evens are. So that spread is getting wider, which means you're actually picking up extra yield buying a nominal bond.
Yeah. And so right? Tyler, that spread is basically real rates, right?
Yes, that is real rates, the spread between. And the ratio on the bottom, which is showing that it's rising, where your bond investors are getting, a real return because inflation 2 years out is falling. So this causes more inflows into bond funds, because they're picking up real yield. So they are hawkish, but here's the thing. They did set off some cracks in the high yield market, which is where I'm a little bit, we've been talking about high yield spreads are in. I've said that for probably 2 months now. Now something switched to just be watching. Look at the slide 15. This is the CDX on high yield has broken out from the 50-day moving average 50-day moving average, and the MACD is crossing up. Mm-hmm. So there's a little credit stress. And now,
can you explain a bit more what we're looking at here, Tyler? So what's CDX? I know high yield is, so it's just, is this credit spreads on high yield bonds?
Correct. And so
default spread, yeah.
If you go to slide 16, it breaks it down by sector.
Right.
So you can actually see the spreads based off high yield per sector. This is today, moved out about 10 bips. And so high yield is down, but like treasuries are up. So that's kind of saying to you, the Fed is over tightened in a certain extent, where now people are more worried about disinflation and deflationary looking forward, right? A lot of the inflation has happened in the past. And I think, perhaps they've over tightened, look at copper is breaking down, metals are breaking down. So I don't know. We could be in more of a disinflationary environment here. and the Fed might be behind the curve on actually easing now, which I'm in the camp with you guys on. So but the main point about the credit stress now is when credit stress rises, then you got to pay attention to equity volatility rising, which is we're kind of getting that today. So I've talked about the whole like when credit is copacetic and calm, the whole buyback machine of issuing debt, then going to buy back your stock, it keeps equity volatility low. That whole cycle gets derailed when high yield credit spreads blow out. So it's not blowing out by any means. We're still at like lows. However, it's like an indicator where let's watch this a little bit, because I think the policymakers, the vol controllers might have maybe over tightened here.
I agree with your synopsis. Most of these points. I think where I maybe where my view differs the most is the subjectivity around over tightening or what they should be doing. Because, if your dual mandate is employment plus inflation, and it's just they know they're over tightening. This is Powell. In 2022 August, Jackson Hole, he said there will be pain, and he's like, oh shit, like that set off the markets in a bad way, and now I actually have to pivot because I set the markets off so bad. This was him saying that without saying there will need to be pain. But yeah, he's saying that inflation is still a problem, and really it boils down to the Fed not having the tools here to fix this. Everybody knows it's fiscally driven, and so he's just trying to get inflation down a little bit more because, he's already, he's going to see housing break out again here without even cutting. And so I think you're right. All the market is giving all these bearish signals, and that's why the dollar's strong while rates are down. But I just think that the Fed gets that, and they want to get inflation a little lower.
Well, here's the interesting thing. Just because people are buying treasuries out of fear today, right?
I want to talk about this. Is we've been asking ourselves, who the hell's buying all this debt? We had two really great long end auctions this week. Like the 30-year was just awesome. So people are buying duration. And go ahead, Tyler. But I want to dig into this about like who the hell's buying this debt.
Yeah, well, check out the DAX. I think I put a chart in there, chart 10. Europeans are buying the debt, right? So you've created a situation where, Europe is on an easing path, and, we're hawkish in the US. So dollar tightens global liquidity conditions a little bit here. And, the DAX broke a significant level. So did the Euro stocks. And then the euro is actually breaking down relative to the dollar. So I think this is causing kind of like a global. And then if you look to chart 11, the TLT is the 20-year Treasury ETF. So that's been in a downtrend, and it just broke to the upside of the weekly, the 50 weekly. So basically, I think global investors are getting a little bit more conservative and looking for safe havens. My conspiracy theory, not to pivot too hard, but like as the polls say Trump is going to be, higher in the polls, Trump is a menace to Europe because he's basically said, I'm going to be pulling funding from NATO. They're going to have to increase their funding for defense, which will essentially like take away a lot of social welfare programs. Now you have, the right is basically taking a lot of political power over in Europe too, anti-immigration, which that's a lot of costs to, deport people or whatever they're going to do. And so that's why I think you're getting this flight to quality in US treasuries. The politics are changing in Europe, and they're the tinderbox of how this world is changing. Right. And I think that, there's a lot of stuff going on politically that's causing this, and perhaps we'll see if it's just a flash in the pan, but we definitely have crossed over some serious like pricing, thresholds.
Yeah. I think that makes sense. I think the argument of this is just, I don't know, dumb systematic flow where it's like, okay, Fed is done hiking by duration. That makes sense to me. Capital, flows into the, it's just like the classic exchange rate 101, where it's like capital flows into higher yielding sovereign markets. That makes sense to me. Quinn, I know you've had some interesting calculations on the long end and basically how, if you're buying it here, you're basically losing purchasing power when you compare it to, say, GDP growth and that sort of thing. Do you want to unpack that one?
Yeah. So, I mean, I hear all these points, but let's go to about slowdown, which, again, I agree there's a slowdown. We're coming down from like 10% nominal GDP growth, which we've never seen. I think it's on the 8. It's a Citigroup Economic Surprise Index for the U.S. So this is basically, showing a lot of the economic data that's, rightfully got the market on edge about a growth scare. It's disappointed. And then if you go to the next slide, so it looks kind of like it's bottoming a little bit. Maybe it goes lower. Maybe it's bottom. Who knows? We need to see the data, and like the Fed, we're data dependent. But what I pointed out on this next slide is, if you look at the bottoms, if there's a Citi Economic Surprise Index bottom, this is just one data point. If you look at the bottoms in this index, August 22, Jan 23, May 23, December 23, April 23, all of these are bottoms in the 10-year yield. And it's no question the market is still in this, 2000s to 2010 regime of, okay, there's a slowdown or recession and flight to safety is bonds. But what I would posit to people is, there's been this huge bid for safety in treasuries down to 4.2% on the 10-year. And this is the market's interpretation of the Fed not providing liquidity. So everybody bidding this I'm asking, like, what's going to happen when they do ease and they do provide liquidity? Everybody knows the fiscal deficits are increasing, not decreasing. And you have the government and policymakers themselves globally, Europe, Fed, ECB, saying inflation is not going below 3%, let alone 2%. So, and then if they ease and stimulate and the housing sector takes off again, and, there's a 5%, 6% fiscal deficit, annual GDP percentage, putting a floor on the economy. So I think we're getting back, and I expect 2025 to be more like it, but that 2022, remember how the phrase throughout was the two-speed economy, right? What's good for markets might not be good for the average Midwestern person or, pick middle America person. And I think, the markets are trying to balance this out, but we're going back to that where inflation is here to stay. And for the financial markets, that might not be that great. But for, the average consumer who's, going on vacations, and that might be okay. And the bond market might still take some time here, but I just would have absolutely no appetite to buy long duration U.S. Treasuries here when it just doesn't make sense to me. And then the top 3 holders are sellers. The top 3 holders are sellers. Japan, forced seller. China, adversary. They're not buying. They would love to, cause some stir in markets before elections. And the Fed they're all selling. Yeah. I mean, it's just crazy.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back permissionless. We're going to be doing permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for a DAS this year, and I hope to see you out in Salt Lake for permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
I agree. I think a lot of that makes sense. I mean, there's an interesting thought experiment that like the long end we view as just basically confidence in the system and confidence in the Federal Reserve. And I interviewed Joseph Wang this week, a couple of days ago, and he had this really interesting point. He, despite the hawkish dot plot, thinks we're going to see 3 cuts in 2024 still, mostly driven through the unemployment channel. But based on that, he also mentioned that when that first cut occurs, assuming it's not I think it's really important to discern what style of cut is it. Is it a normalization cut or a recessionary cut? If it's a normalization cut, he views the short end coming down, obviously, because they're cutting, but that the long end would go higher. not come down with it in any way. So he views that as basically this play of basically, for less trust in confidence in the Federal Reserve in managing and controlling inflation. And I think that's a really interesting idea, is that we could potentially see this huge dispersion where the short end comes down and the long end goes higher. The second order impacts, I don't really know quite yet. I think you had a couple good ideas in there, Quinn, but I don't know, something to think
horrible
about.
For asset prices. When they find at some point in the next few years, they're going to have to, I mean, they don't have to, but to get to any normalcy in a monetary plus fiscal policy, they have to at some point let the long end trade. I mean, there's already talks about it. Barry Knapp and Jack had a great podcast. Barry is absolutely brilliant. There's already talks within the Fed about potentially moving to a bills only balance sheet policy for the Fed, and that would, but you can't transition there overnight. They control.
That'd be like basically pre-2008 regime.
Yeah, and all of this stuff is really not good for asset prices, because the 10-year is what dictates most capital allocation decisions.
That's really fascinating. I've been thinking about this just existentially, because if I kind of am the same camp where if you let the yield curve really steepen, things are going to blow up, and they're going to blow up because the government's balance sheet really stinks, right? At the end of the day, they need to finance themselves. And that's the biggest problem. And I think they've essentially nationalized the bond market. I think the US has deceptively nationalized the bond market, and any little hint of credit stress like we're starting to see, we'll see how fast it takes for them to stomp it out. Because I think we're watching a blow off top in tech stocks, right? Everyone is now coming into tech stocks because there's a growth scare. You can see IWM rolled over, ARKK rolled over, the Goldman short basket's rolling over, and the last generals are going up. And now, but here's the difference. I was in the short volatility selling the VIX camp for a while, and now we're seeing implied correlations are going up, which is you're seeing implied correlation hit a new low yesterday. It's up 10% today, and the VIX is up 7%, and the Qs are up. So now it's a race to buy upside, which if I was, I don't like tech here is my point. I think you're probably going to get a nasty drawdown as soon as the buyback blackout window comes into play. And today, June 14th marks the start of the share buyback blackout period, which is set to last until July 19th. So my whole short vol, what really the engine of the market during that blackout period, you just that's the time where vol can spike, because that $5 billion a day goes away. And then all the CTAs rush to buy protection. They delever their books. I think we're probably heading into that for the next month or so.
Mm-hmm. Tyler, can you explain? I'm going to put my hand up and say that I don't trade single equities. So the blackout window, I hear a lot about it, but I'm just going to be honest that I don't understand it very well. Why is that even there, that blackout window?
Because before you report earnings, you want to make sure that you're not messing with the stock price, and it's just a coordination thing where they can't, they don't want to mess with price performance. Right. But the irony is they do, because the market structure is so messed up. Historically, let's just take a step back in time. Historically, 50, 60 years ago, when you bought a stock, you called up your broker and you got charged a commission to buy a stock. And I could probably get better dates for this, but then it turned into you buy a mutual fund. They figured out if you diversify, then you can, have risk adjusted returns. So you bought a mutual fund. The commission on that was, that was high too. Now go to chart 12. Over time, there was technological advancements in markets where the spreads, you didn't use the phone anymore. Eventually, you could use the internet and the spreads collapsed, right? So this is the blue line basically shows over time since 1995, spreads between the bid and the ask, what buyers and sellers are paying, just collapsed. Now that allowed the evolution of ETFs and the passive market and quantitative stuff, because it allowed, look at the trading volume is in the gray. So average daily volume of shares in billions just went skyrocketing after that. So commissions come down, there's lots more to go. And then the high frequency traders come in, passive comes in. And so this is essentially everything. I think what's way more powerful here to realize is that this is all a technological evolution where people piled into passive because it was the cheapest way to get access to investment. And now we're seeing the end game of that. Like, you're now paying for flow at Robinhood because like pay for order flow type of thing. That's probably going down a rabbit hole. But the end game is, this is why we're seeing that concentration in stocks. This is the centralization problem on steroids. Basically because they cut fees to like, it doesn't cost money to invest anymore. And so it concentrates into certain scalable assets, scalable things. And it just so concentrates into like Facebook, which is scalable attention span, right? Anyway, the long story short is, now that your floats are concentrated in these passive entities, there's guys like Roaring Kitty that figured out, I can actually utilize that float dynamic to create volatility as an asset. Now, what do I mean by that, right? If they've nationalized the bond market, essentially, because of pension flows, endowment flows, all these like baby boomer type institutionalized things, then your stock, the buybacks curtail the flow, and then you can basically create volatility in your stock price. Now, why that's so important, and to stop me if I'm like going down a rabbit hole, but you used to issue debt, right? Now, if your stock price goes bonkers, like GME did, volatility in your stock, you can issue a convertible bond, right? Mm-hmm. And what a convertible bond is you sell a bond with a call option attached to it. So you lower your cost of capital by selling a convert.
And those yields are often much lower than typical bonds.
Exactly. So so if you have a high volatility in your stock price, you can sell a convertible bond, and it creates, you lower your cost of capital if you have high volatility. So they're rewriting finance textbooks right now, is sort of what I'm saying. This is what happens when you centralize the market so much. Now, someone named Michael Smaler has done this, right? Where he's created volatility in his stock and then, issue converts. You can do that in GME. As passive takes bigger and bigger parts of your float, like that, and like NVIDIA is another example. Like that keeps shrinking and shrinking because like benchmark risk, passive, et cetera. And eventually you might be getting like that gamma squeeze blow off top, and you can issue credit at like such advantageous rates. But this is why market structure is so screwed. And eventually, like nationalizing the bond market, this stuff is just going to keep happening. Now, they might get a short, brief period of like credit stress here, which unwinds all that. But at the end of the day, I think that's why the people who figure out that volatility of stocks can be an asset on your balance sheet will end up buying Bitcoin. That's sort of the end game of this all. It's all an arbitrage of centralization versus decentralization. Now that I probably butchered, I got to figure out a better way of communicating that simply, like tell a story around it. But if you're a high finance person, like, and you figure this out, it's mind boggling what's going on.
Yeah. I mean, maybe I could try a couple of the big picture takeaways, but to me, it's like, okay, the long end bond market, like fixed income bonds, are just, as we've explained, a mess for people to hold and protect their wealth in. They're getting chipped away by inflation, by all of that. And then at the same time, we're getting these mega cap stocks where people can passively bid into them. And now a lot of them are even like giving out dividends as well too. So to me, it's like, okay, people are also bidding passively through these ETFs to basically use this as a protection vehicle, and equities are like nominal assets, so they're going to keep up with inflation too. So you have these drivers of flow that are not based on price multiples or DCFs or anything like that. So then you have this dispersion where, you have the traditional guys that are saying, okay, why is everybody buying, the Qs when the forward PE is ridiculous? But it's because they're buying it for these different reasons that you're explaining. So it's much more useful to look at flows, market structure, and those sort of things, because that's what's driving it. And I mean, the idea of a DCF and like, okay, we're buying the sum of all discounted cash flows to the present value, like that's just something we've agreed upon. But I mean, I always loved the fresh takes of some crypto people where they're like, like DCFs are a meme. Like a meme is something we agree upon as a society. And so it's like, okay, we've decided on a society that this is what's most important. But I think what you're showing now is that this is evolving for really interesting reasons.
Well, I think what America made, this is like a larger macro thing. The compromise they made was they just wanted cheaper labor. So they went and globalized the whole world. And then you got the cheaper labor, and then you had all these technological advancements, and you just made everything, all the technology made everything cheaper and cheaper and cheaper, to the point where you didn't realize, like, when you make things so cheap where they're free, there's side effects. And, it's centralized. You create, it's world controllers. You have, and then when centralization gets so bad, you have the social contract breaking. And I think that's probably a better way of putting it, is like when spreads come in and everything gets so liquid and information is commoditized, then like the ones that can glean something from that information take all the power. And that's sort of what passive management has done. And so now we're seeing like guys like Roaring Kitty figuring that out. And they're like, how do we destabilize this passive management? And as you go after specific, and that's why like this is diversification gone amok too, right? Now you're better off staying in a really concentrated book of stocks, instead of this diversification at this point.
I mean, Tyler, just for people listening, like I've never heard, I'm no expert, but I've heard a lot of takes on this market structure stuff and breadth, and I've looked into it, and it's one of the most eye-opening takes. Like when you combine that all this stuff with the fact that over 50% of flow is in volume is HFT and not actually buyers and sellers, and you just realize like it's like the same low float high FDV thing. And if you have these passive vehicles where NVIDIA, every dollar that goes into passive vehicles, 40 cents of it goes to NVIDIA and Apple and whatever. Yeah. And it's only one directional flow, and there's no sellers ever because the labor market's strong, et cetera. Yeah. It makes a ton of sense. The thing I would like to posit that you often have been hearing in the markets for the last month or two, breadth is terrible, breadth is terrible, breadth is terrible. And what do people mean by that? They mean exactly what you said. The top 3, 4, or even one stock, NVIDIA, is getting all the assets, all the flows, all the buying, and everything else is actually deteriorating under the surface. But the indices keep going higher. Okay, so that can be good or bad. It doesn't need to necessarily be, it just is what it is. But people calling for that to revert in that healthening, widening out of breadth, that doesn't happen when you have a hawkish Fed into a weakening economy and slowing growth and unemployment rate rising. People don't wake up one day and say, breadth is way too low here. I want more small caps. No, it releases. They do that. If Powell would have came out like the dove we all thought he was going to be and said, oh, wow, inflation, it's perfect. We're doing our job. The labor market is coming down. We're going to cut. July's on the table, maybe 2 or 3. We don't know. You would have seen this monstrous small cap crypto, everything. I do think you get that huge move. And people do not understand that, like, that's why we trade markets every day, because stuff changes and unexpected things happen. The ETH ETF went from a 0% chance to 100% chance overnight. It's the same thing. Powell came out and crushed it. But my point is looking for this healthy widening of breadth and small caps to wake up on Monday and do well, because for some reason, without any change in this current trajectory, is nonsense. And to me, that says you have to release down before you can get that reaction where they can healthily broaden breadth. And that's my biggest fear. And everything we've said, I can agree with that. The Fed is late, the economy's weakening, all this stuff. I kind of still sit in the camp that growth is somewhat fine, but I still win if I'm right in my view that we release to the downside because of this.
I don't know what's going to happen to the down. Like, you could see a Fed pivot tomorrow if they just start, chattering. But it does make me a little bit nervous here.
This morning, Mester said we need multiple months of better inflation data. We got one. And I'm all on board for them going to be cutting in September. I just think they need more reason to do so. And the market will give them that reason with a good 10% correction. And then you bet your biscuits they're going to be pivoting to rhetoric.
Bet your biscuits. That's very Wisconsin.
Oh, yeah, there. Oh, yeah.
Oh, you betcha.
Oh, you betcha, yeah. But until then,
I think we're in the same camp on all this. But and to agree with you, the end game at the end of the day, if Trump gets in and he's going to weaken the dollar, clearly we're relatively tighter than the rest of the global economy. And if you weaken the dollar here, you're going to release some major nominal growth, but you're also going to release some higher inflation. And I don't know. I think Bitcoin goes bonkers in that scenario at some point. But
I do too. I think there's so much of what we're talking about here that gets missed with people that either lightly follow macro or maybe just beginning their trading journey. Is so often I see, Stan Druckenmiller is right 60% of the time. He's wrong 40% of the time or something like that. And he has one of the best win rates around. Like, you need to shift your mind towards probabilistic thinking to be evolving it. And there's a big difference between us pontificating on a podcast and what we actually execute in the markets. Is that, I've been a big believer, for example, like fiscal dominance leading to a floor in GDP growth, leading to like an outsized strong economy and all of those things. But I'm also starting to worry about what I'm seeing in terms of a slowdown, in terms of Fed getting late to the party, in terms of, just their simple heuristics of being burned early in the year. So now they're going to overcompensate and those sort of things. But at the same time, I also believe that like a recession is unlikely because of the fiscal dominance and fiscal deficits that are occurring. But at the same time, I'm also thinking about, okay, what would happen if I rise my recession probability from 2% to 10%? Like, that's still not my base case, but it's something that is shifting my views a little bit. And I think what's really great is that the three of us do a decent job at that. But I think it's really important for people to really understand that you can hold two views at once and just weight their probabilities differently. And that's how guys like Druckenmiller win.
And I got to, not to talk so this tweet I put out yesterday on this bear thread or bear tweet on altcoins, because I just don't see any buyers in the market for this. And I don't need to go into the detail here, but the amount of hate and visceral reaction, I've never had a tweet. I know I've said a lot more controversial things in my life that altcoins are going to go down. And I've never seen such a visceral reaction. I mean, this thing, and it blew up. And, half the replies were, thanks for the bottom indicator. Others were like, people basically saying, go, like, you're an idiot. And so that just tells me like where consensus is at and where the pain trade is at, right? Like, the market tends to do funky things and clear out both sides. And I may be wrong, and that's fine. And I'm going to survive if I'm wrong. I'm not like a crypto degen trader who puts 100x leverage on the direction I think it's going, because I know I'm wrong a lot. And like you said, but the other thing that people were like, couldn't get their heads wrapped around were like, oh, but a month ago, this podcast, right before, like the week before the ETH ETF news, you guys said bananas on. And I said, well, ETH, Sol, every alt went up 20, 30% the week after we said bananas on. So at the time, that was the right call, but there was no follow through. We had crazy ETF inflows, no follow through. We had every regulatory piece of good news, no follow through. The market's telling you something. It's tired. There's not enough buyers to push through. There's a lot of sellers coming out. Leverage is flush. Positioning is still there. Option skew is still directed towards calls. I mean, in the equity markets, we saw the highest or the lowest put to call ratio ever since 2021 yesterday. So there's all these signs adding up, and if you're a market, you're managing money, you can't just sit in your views because you said something 3 weeks ago or a month ago, and there's new data. And I full-heartedly believe if the Fed was dovish like everyone expected, I think we would have ripped, and who knows where we would have ripped to, but I think you would have seen, and maybe the S&P would have actually been lower because people would have ripped into small caps and crypto and all these other things and not NVIDIA, because they're like, oh my God, the Fed's going to ease. I can buy other stuff that's not just AI. So there's all these funky aspects of the market that it's just very complex, and you have to be on your toes. You can't marry your views, because that's why the markets are open daily, because new information comes in.
I'm in the camp we're in a long-term, liquidity cycle of positive liquidity. But here we're in this little soft patch, I think, in this next month of buyback window closed, Fed a bit too hawkish relative to other central banks. That's important. Like when you look at like the euro and the yen, that's really telling you something. They're very weak. And one thing I'm really paying attention to is this, it's like Bloomberg Asia Dollar Index. And all these Asian currencies are really getting hurt pretty badly. It's like it could create like a dollar margin call if that breaks lower from like 90 level. I'll probably show that chart next week, but we need a weak dollar. And I think it's inevitably they're going to force the market into a weak dollar eventually.
But not right now, because the Fed is hawkish and every other central bank is dovish. So I agree. Yeah.
Well, I think this is like, be careful here. Wacky things happen when things are so extended, especially when you have a concentration of stocks in, 5 stocks, like cover your ass. Like I wouldn't surprise me if we saw like the Qs down 5% and then IWM up 4% off of like a giant quant rotational trade off a headline. Like that's how extended we are. And it's really wonky. And like implied correlation hitting like all-time lows. That I thought, I'm just going to go out on a limb. That might have been the blow off top in quantitatively managed shit. Because it was like, it was such lows, and now it's coming off the lows, and the VIX is popping here a little bit. We'll see. If implied correlation dropped any lower, then one guy would rule the entire world, like Larry Fink.
When you say it was at lows, was that at like 0 or like negative?
No, it was at
1 or
9. Let's see. If you go back, it hit like 8 something.
Okay. Yeah.
So basically, everybody, quant funds, when implied correlation is low, or CTAs, they lever up, right? Because that brings down, the VIX. And so we're probably getting into too much detail, but everyone's concentrated in the Qs right now. And in fact, the Qs are outperforming so much, it's sucking money away from other parts of the market and creating that herd mentality thing.
I think it's simple. I think all this boils down, and I tweeted this like 3 weeks ago. I said, just watch the DXY, and the DXY will give you the green light. Rates going down 40 basis points in 15 days, you could look at that and say, oh, wow, easier financial conditions. But the dollar is higher, and financial conditions liquidity is tightening. And there's just the only way that dollar weakens is if the Fed comes out and says, we're monetizing something. Maybe they won't cut rates, and maybe they'll end QT, in July or something. But the dollar doesn't come down just because, like,
I think looking at global capital flows like that is the key for the summer, because now that we're having this dispersion in central banking policy, more money will flow into the dollar. But they're also going to be wanting to buy U.S. bonds because they're going to be yielding better than their own domestic bonds because now they're cutting. So I do agree that's going to be the key.
They're going to until the Fed starts easing again, and then they're going to say, oh, shit.
I don't know. Here's a thought experiment, because if things are so bad in other parts of the world where, like, Europe is selling off, sometimes they repatriate capital. So they could be selling. I mean, watch the LQD in HYG. They could be buying U.S. Treasuries for the reason of a growth scare or some geopolitical events, but also selling corporates. That's why you have to watch the credit spreads, which are widening, right? Like you could see if the Japanese yen falls really hard here, you could see Japanese investors who are the largest yield investors in the world repatriate and sell bonds. That is the key to this whole thing is like Japanese investors. If they start selling bonds, like that sends off rumbling across every asset class.
I was going to say, if you want to know one of my favorite indicators for, things are getting weird, and not always, but the JGB 30-year minus 10-year, because they don't control the 30-year, they control the 10-year. So when stress is rising in that system, you have the 30-year selling off more. They keep the 10-year more in control, and that spread widens because the 30-year saying, guys, you're running way too loose here. You got to tighten. And they're holding that 10-year constant, the 30-year selling. And you look at it in October 22, it's kind of coming up on those highs again. And like something's got to change there. And we all know what it is, right? We all know what it is. It's the Fed has to start monetizing more. They have to help the other central banks. The other central banks are going to be screaming bloody murder in the next couple months if this course doesn't shift. And then it's a great time to buy Bitcoin. But until the Fed comes out and says that, like you're rolling the dice that you're trying to preempt something. And we know that they need cover.
Did you guys see the BOG meeting last night where they announced that they're going to be slowing down the purchases of JGBs as well?
Yeah. The interesting thing about that was that JGB, the 2-year JGB fell below the 50-day moving average. So
it's interesting because they leaked the headline a few days ago about that coming, and then they came out, and it seems like people thought it'd be even more. I mean, this just the forward guidance bullshit world we live in, but like they're slowing down purchases. It's just because of the way that they commingled the media into it. It's like, oh, look, yields went down.
Leak it. This is the world so good. I got to write a screenplay about this. Just,
so good,
world controllers. What did you expect when you globalized the world? Like the fact that I'm watching, JGB prices like a hawk in, the Chinese yuan, it's kind of ridiculous when you think about it. You're supposed to buy stock because you like an idea.
Man, I used to be a huge value investor and I loved it. But then I went down this world and it's like, oh shit, like the discount rate is a mess.
But I get why private markets, like why would you go public if you go public, you got to figure out the game to play like Elon Musk did. But like it's the incentives to stay private. It's why the market keeps shrinking and shrinking and shrinking. It's because like the public market incentive is just really bad right now.
When I grow up, I want to be a CEO of a random company that becomes the meme stock of that generation. I mean, the GME CEO and C-suite is like equivalent to like bonk coin founders. It's like, let's make some bullshit coin and it latches on and now we're billionaires. It's like hilarious.
All right, so their implied vol is 3-month implied vol is 167. Like they could sell a convert and then go buy Bitcoin. What's really fascinating is like they have all this cash, and if they want to increase the volatility of their stock and keep this going, like it makes a lot of sense.
I mean, like Elon says, the funniest outcome is the most likely, and that is just absolute hilarious simulation stuff. So I could see it.
And the irony of the whole thing is it's called GameStop. Like if you just step back and we're living in a matrix, like it would stop this stupid game of like investment. Like how that's interesting.
You know what I'm waiting for, Tyler, is and you'll like this one. And Jem Carson has been talking about this this guy's good, by the way. People sometimes think he's talking Fugazi with all the volatility stuff, but it's just because people don't understand it.
Yeah.
But wait until the roaring kitties of the world latch on to puts and the reflexivity of the volatility and gamma on the downside. Like that's I think that happens at some point. Like let's say roaring kitty gets creamed on this GME thing and the stock just gets crushed. Like he's going to be back, or someone's going to be back with like a revenge of roaring kitty's demise. with we figured out gamma goes in the other direction too, and 0 DTE and all this vol, and now let's try it on puts instead of calls and see if Cliff Asness is calling me, like you're gonna like you see this visceral reaction on Wall Street when these guys are pumping to the upside, and it's affecting like 1 out of a million, institutional Wall Street high finance people, like the random funds that are short the one stock. They're going to figure it out to the downside and sayonara.
How does that work again? Like if DGens are buying puts, how are dealers hedging? Because they're selling puts
they're shorting
to the
DGens,
so they're shorting the stock. Yeah, that's what I thought. Yeah.
And then it gets reflexive because they're exactly short call short puts and it can compete, it's kind of like if you go down here, but you stay, you're okay. You go down here, you've seen this, right? The Vanna and charm flows. And then, but if you break that tipping point where then the dealers are offside and actually have to hedge more, then you kind of run into trouble.
Okay. The only way that works is if they let the bond market and market prices flow freely. And this is where like I wrote an article about this years ago where I was like, if the Fed lets the markets go freely, you'd have sort of a scenario like that because you'd get outflows from passive funds at that point, which would be so easy to short. Could you imagine if you found out like, passive flows where they're actually having outflows?
Well, unemployment rate going up.
Yeah. Well, that's why, we're getting into like some funky territory here, but it really is, I don't know. We've really destroyed market structure at the end of the day.
You know what happens when we do that is I want to shift. We've been into big macro stuff, but you know what happens when you break markets? You get celebrities starting to friggin' launch meme coins and tattoo Solana on their heads. And this is our meme of the week of Lil Pump. When I saw this, I got really scared, man. Like, God, what is happening in crypto right now? Like there's nothing happening on the tech innovation. We just have D-list celebrities launching rug meme coins every day right now. You have Lil Pump tattooing Solana on his head. Like, I don't know. I posted this tweet yesterday where I was just saying I have way more conviction holding equities right now than crypto. And it's just, it's stuff like this.
Yeah, I'm with you.
I mean, this is froth top signal, number 8,432. Like it just, for people to be so blind to it time and time again, like, when to fade the crypto Twitter universe is when they overly latch onto macro in their processes. And all you see is, but the Fed's going to cut, but the Fed's going to cut. What universe are you living on? The Fed just said they're not cutting. They said it was the hawkish they've ever been in 2 years. Like, this is just lies. And anyways, people are going to pay the price, but I'm trying to help people and people get upset. They don't want to be helped.
Well, if you've called it pretty well, in your defense, and if you pivot back bullish, like this, you're more of a trader than an investor. I think your long-term thesis is like crypto will be a thing in this battle of centralization versus decentralization.
Oh my God, we're getting some sick wicks down on crypto right now. Anyway, sorry, go.
Yeah, but like at the end of the day, I think they have no other. The generational imbalances are too large where they have no other way to rebalance our U.S. economy. We have to reindustrialize. We have to have a weak dollar. We have to have, a wealth accumulation for Gen Z and the next generations to take care of all their debts. And so the longer term thing, it's okay to be bearish in near term and wait on the sidelines for stuff. That's sort of what I'm saying.
Yeah, and that's a good point, Tyler. Is my my time horizon is significantly different than many people's.
Yeah,
and that's fine. And everybody approaches things differently. And yeah, and right now, just as we're ending this episode, yesterday I used the words, I think there's serious cascade risk, and Solana's down 5%. So
we are cascading right now. Yeah,
whatever that means for your alts, this is just. I'm done. I don't want to.
Let's end it before everyone goes into a depression.
Yeah. All right. This is a great episode. We got into some meat here. We got into some real like conceptual. This is stuff you got to be thinking through. I mean, it's, I think there's a lot for people to dive in and kind of research more on their own about.
I'm with you.
I think so too. Anyway, you called the cascade. It's happening right now. Great job, Quinn. I still think the Fed is going to be dovish sooner than later. They are buying themselves optionality, but there could be some mess in the meantime.
Stay safe.
Stay safe. Stay alert.
Just live to see when they do, because it's going to be glorious.
Yeah.
Hey, fellas.
Yeah. All right.
Have a good weekend.